Yep.
I see my name in black. I don't know why the video went away.
Maybe.
Stop video. Yeah, video is like there. How's that?
Now you're back.
That is weird. It just did that all on its own. I wasn't even near the computer.
Let me tell you, man, technology, it's a big time hassle.
Yeah.
And this is a family friendly show. So, hi, everybody. Welcome to Family Wealth Builder Academy. I'm Jim Munchbach, and I'm your host. And this is Jim Pritchard. Jim is going to tell some stories about risk, managing risk, and he's got some great stories. So, how you been, man?
How you guys doing?
Good. This is going to be Facebook Live, so it'll take a few minutes for anybody to get on. But do you do Facebook?
I do. Yes.
Cool. Well, just so everybody knows, I know tricky business here. We are recording this on Zoom, and this is our second time we did this, and it didn't. Somebody forgot to hit the record button. That would be. So we're recording it on Zoom, this interview, test driving our technology, and I'll turn around and I probably won't edit it too much unless Jim, has a brain fart. Either of us.
That's happened before, so
So anyway, so I'll record it and then I'll play it live on Facebook, and when I do that, then I'll be able to be on Facebook commenting and sharing my hellos to everybody, and Jim will be doing the same thing. So that'll happen Facebook Friday.
Facebook Friday, I gotcha.
Yep. Well, man, it's good to see you. You're looking good, just like you were last time we did this, except you're wearing different clothes. So the market has been a little bumpy. It's like a roller coaster. The election, I voted today. Early voting in Texas is a pretty cool deal. So
I did that as well. We sent in our ballots through the mail. Is that what you did, or did you have to go somewhere?
I had to go somewhere. I had the privilege of going to the courthouse.
Yeah.
City.
Well, it's good actually the way we did it, because you get to look up what they're trying to say in some of those ballot issues. The way they word those things, you have no idea what the actual issue is.
You're absolutely right. I'm going to confess, maybe I'm not really a proud Republican, but I voted straight Republican. I believe government should be smaller, not bigger, and it's a necessary evil. And I have several friends who I voted for today who are Republicans, so it was easy for me. I just closed my eyes and hit straight ticket.
Yeah, I'm a libertarian, which is, traditionally a far-right Republican. However, I have more liberal leanings on some of the social issues. So I typically vote independent, where I look at the issues and look at each candidate instead of going straight Republican, as I think many libertarians probably do. So
I think that has a whole lot more integrity, and in my heart, I am completely 100% independent. But in my laziness, I'm closing my eyes and hitting the Republican.
Gotcha.
And it was amazing how many people I actually know and am friends with. I looked on the ballot, and Greg Bonin was there. He's in Texas legislature, and we were on a trip to Mexico together with our families. So I know some of those guys and ladies, and they're good people. I know they're all trying to be good people. So enough about politics.
There you go. We probably shouldn't talk religion then, right?
I like talking about we shouldn't.
Okay, let's not.
Maybe someday over coffee.
There you go.
So tell me about what you do. Just give good old-fashioned introduction, who you're with, what you do, why you love it, and kind of how you got there, whatever you want to share.
Okay, well, again, my name is Jim Pritchard. I'm a partner with W.E. Donahue. We're a money manager, and our customers are investment advisors, financial planners, brokers all over the country, basically. And I'm a partner. Basically, what I do is I help spread the good word about what we do. We are a tactical money manager. Our main goal is to prevent large drawdowns in portfolios. So we have some technical signals that help us do that using math instead of emotion. And I've been in the business since since 1980, when I started as a college agent for Northwestern Mutual in New York City. And then that next summer, I worked in the city. I grew up in Buffalo, New York, but I worked in New York City as a life insurance guy for a company called Circle Financial Services. I don't know if it's around anymore. And what I did was I cold called on life insurance, not life insurance. I cold called trying to sell life insurance to Columbia Business School students. Talk about a hard sell. That was pretty brutal.
Yeah.
After that summer, then I graduated the following year, and I got a job with Smith Barney, trained in New York, and went out to Scottsdale, Arizona, and sold municipal bonds. I think we talked about this yesterday. 10% triple tax-free municipal bonds is how I started. The interest rates at that time were about as high as they've been. I think they peaked out in 81 and started slowly coming down since then until this past year when they bottomed out, and now they're ratcheting up a little bit. But my whole career, interest rates have been a steady, slow downward motion. And, nothing comes straight down. So there were points in time when interest rates were rising during the last 38 years. But started with Smith Barney, and then I went and I was going to move from Scottsdale, Arizona back to Western New York, and there was no Smith Barney office. So I had to figure out what to do, and I looked in the back of a registered rep magazine and saw this firm called Private Ledger advertising much higher payout percentage than what I was getting with Smith Barney. I looked into it and I signed up, and I was independent from Western New York State, and did that for about 6-7 years. And then moved to Colorado, where I brought my own fee-only business, investment management business. I had transitioned from a commission-based stockbroker to a fee-only money manager.
Wow. Big transition.
Yeah. It was. I think at the time it was sort of. I was one of the few that started out doing that, and you take a pretty big hit in income, but what you lose in income, you make up for in feeling better about yourself and your customers. You get more sleep because you're on the same side of the table as the customer, as opposed to trying to sell something every time. Now, as a fee-only guy, what you do is you look at the client's investments and their goals and their dreams, and you try to do the best investing for them based on that, and not based on trying to generate commissions.
Yeah, I had the same transition myself, going from Morgan Stanley on Wall Street to becoming an independent registered RIA, registered investment advisory guy.
There you go.
In the process, I was a fee only. So that, for me, that meant being a member of NAPFA. Were you a member of NAPFA?
No, I never was. I was a certified financial planner. There were so many different organizations and associations I was in. There was only so many I could do. I did the NAPFA deal.
Well, I am a certified financial planner. I was the first CFP in the Houston area who was a State Farm agent. I was the only State Farm agent in Houston who could charge a fee for financial planning. And then State Farm decided they didn't want to continue to have the fiduciary liability. It was a precursor of the DOL.
That's what everybody has to have now, right?
Well, I mean, State Farm thought, with one State Farm agent, it was a CFP, that was not something they wanted to manage.
Interesting.
So, yeah, it was interesting. That's when I went to Morgan Stanley and figured I would work on Wall Street. But like you said, the distinction between working on Wall Street and being an independent fiduciary, fee only, however you frame it, if you're independent and you really get paid from the client for providing honest advice and service, it's a very different deal, and it's a whole lot. I like it a lot better.
Oh yeah, it's better. You can sleep better at night. Your clients can sleep better at night. It's funny how the transition for me. I started with, as I said, with Smith Barney. But before that, I had a choice to make on who to go with. When I got out of college, I decided I wanted to go the investment route, more of the investment route and less the insurance route. So I interviewed with investment firms, and one of them was one of those pump and dump companies that you saw in Wolf of Wall Street. I know a lot of people saw that movie, and in that movie,
Wolf of Wall Street.
Yeah, the Wolf. Yeah,
you're gonna go there, really. The Wolf of Wall Street.
Yeah. So the deal there was, if you saw the movie, you know what they did. If you didn't, I'll describe it in summary. These companies would invent a name of a business. They would issue stock in the name of that business, and then they would invent a story based on what they wanted to tell the retail public that business did. And the whole goal was to take the stock from $1 a share or pennies a share up to approximately $10 a share, wherever their goal was for taking profits, and then sell it. So what they would do is they have this great story about this awesome company, and that company didn't exist. The stock existed, so the firm would start cold calling people and trying to get new customers and using old customers, and they would tell the story, sell the stock to unsuspecting retail public. And eventually, when that stock price, as people were buying the stock, the price went up and up and up. And eventually they'd pull the trigger, meaning they'd say, okay, we're selling all of our stock, meaning the company, the brokerage firm. They'd sell all the stock, and the stock price would plummet. And then they would talk to the customers who were left virtually without anything and say, oh, it's just bad luck. That company, didn't do so well. That's called the pump and dump. You pump up the story, you pump up the price of the stock, and then you dump it. And that company was First Jersey Securities. And luckily, I did a little research, found out they didn't have such a great reputation. The actual guy that ran that company ended up in jail. I think he was in prison.
Now, did you go to work for First Jersey? What was it?
First Jersey Securities. No. So luckily, at the time, I got an offer from Smith Barney. And I thought, well, Smith Barney, man, that's awesome. They're a big blue chip firm with a great reputation. So I took that job. And
cool.
They trained me on Wall Street.
Did you get to do any training with this First Jersey shop, this pump and dump shop?
No, but I was in their offices quite a bit for about a week while I was, trying to decide what to do, and saw, the guys cold calling and telling the stories and all that stuff. So if you haven't seen Wolf of Wall Street, I think you can get on, it's either Netflix or Amazon now, and you should watch it, because it really scares you as an advisor. You see that kind of stuff, and you understand why some people out there on Main Street don't like Wall Street.
Yeah. And now, when we met in San Antonio a couple weeks ago, we were both at a Riskalyze conference, which was really cool. I'll just put a little plug in. Riskalyze is the tool that we use at my firm to help manage risk and opportunity. And it's a great tool. I've always wanted to use it. We couldn't use it at Morgan Stanley. So it's kind of the centerpiece of our tech stack. We call it a tech stack. We have certain very expensive but very effective pieces of technology, and Riskalyze is one of them. And so Jim was at the conference. I was at the conference, and that's where we met. And Jim, you told a story about pump and dump. And when I think of pump and dump, I think of what's happening right now on Wall Street. And, it's not quite as ugly as what you just described. It's not quite, we don't make up stories. We just, and I say we, I mean Wall Street. But there's a whole lot of buying and selling going on behind the scenes to manipulate the price of stock. Would you agree with that?
Well, I agree with it. I don't know a lot about how it's happening. I know that as you buy a stock and you can manipulate the price based on how much buying volume or selling volume there is. So bigger firms can affect that. If a firm, say a Wall Street firm, puts a buy recommendation on a company, most of the time that company the stock price will go up because people will start buying it. And it's possible they might have ulterior motive where they're going to, once it hits a certain price, they're going to start selling it. That's certainly plausible.
You mentioned at one point that you're a chartist, you're a technician. You pay more attention to the math and the charts and the algorithms than you do the fundamentals. And I understand those and use them. And I know a lot of folks who do day trading, and the whole pump and dump deal, that seems like something that, because we have so much access to technology these days, there's a whole lot of people that are buying stock and selling stock on those highs and lows using those charts. And
sure,
I teach at U of H, and I was teaching investments the other day, and I just taught the students about the whole idea of shorting a stock, and then the opposite side of the short squeeze when there's so much stock shorted. It's got to go up at some point. Anyway, people get squeezed out. So some fun stuff there.
Yeah, they're always looking for those technical signals. There's a lot of different signals, as you know, if you've done any day trading. They're looking for volume, buying and selling volume, and price levels are big. So when the stock hits a certain price going up or down, there's either support or resistance, and they trade off of those. And now with computer algorithms doing some of that trading, you can get hit pretty hard on the upside or the downside as soon as one of those price targets is hit, and the computer fires off a bunch of orders. So it makes it a little harder. I've always said that the market on a daily basis seems more like a game. On a long-term basis, the stock prices kind of go where they should based on how well the companies are doing. Sometimes when you get certain companies, we've seen the last couple of years, the FANG stocks, Facebook, Amazon, Alphabet, which is Google, Netflix, those prices just seem to keep going up and up and up, and the earnings for these companies don't necessarily always match where the prices are going. Right. So that makes it a little scary too. And if you looked at the stock market the last couple of years, the S&P 500, the largest 500 stocks, it's really being driven by these FANG stocks. And so I think let's see, what's the date? November 1st. So about 3 weeks ago, I think it was October 12th, there's some stats that came out that said 80% of the S&P 500 on that day were in a correction. That means they were down 10% off of their highs for the year. And of those 80%, there were 160 individual companies that were in a bear market. That means 20% off of their highs for the year. But nobody would have known that listening to CNBC and all the talking heads, Fox News, all those things where all they're talking about is how the markets are hitting new highs. Well, most of the market wasn't doing so well, and so those highs that were being hit were being driven by those largest companies.
Yep, and those largest companies, you mentioned the FANG stocks. That's Facebook, Apple, Alphabet or Google, Netflix, FANG, and that's it, right?
Yep, that's it.
And if you look at their charts,
there are a few other ones as well.
Yeah, they call them FANG stocks though because they're tech.
Right.
They fell hard.
They did fall hard. They've made us. I mean, they're most of those are down in correction territory. Yesterday, day before, they bounced a little bit. They might be bouncing today. I haven't really checked.
Yeah, they bounced today. I put a position on Amazon, and it's come up a lot. So,
well, that's good.
Yeah, it's good.
So, so what we try to do at my firm is we want our customers, and our customers are advisors like Jim all over the country that use us for their retail clients. So mutual funds and separately managed accounts. And we're trying to prevent those big losses like people saw from 2000 to 2003 and 2007 through beginning of 2009. We want to prevent those 30, 40, 50% losses because those are really hard to make up from, right? And especially if you're retiring today, put your money to work and you might have to go back to work if you lose 30, 40%.
Interesting statistic I like to ask my students is, let's say you have $100,000 and you lose 50% of it. How much do you have to gain back to get where you were?
Yeah, and a lot of people don't know that you have to get 100% of your return to get back where you were. But if you're down 10%, you only need 11 to get back. So if you limit your losses, you're much better off in the long run.
Yeah, so that's really the kind of, that's what you guys do, and that's what I was attracted to when I met you and heard your story and got to know your firm a little bit. And by the way, I did look at your fact sheets, and you have a good number of funds, and all of their names are quite interesting. And I was just curious, do you have a favorite?
Well, I really like, we've got a couple of dividend strategies that I really like. One's called Power Dividend and the other one's Power Dividend Midcap. So I like those because dividend stocks tend to outperform over the long run. We equally weight those stocks in the portfolio, meaning we give every stock gets the same dollar amount per account. That's called equally weighted, and that's different than the stock market. The S&P 500 is cap weighted, so the bigger companies get a bigger percentage. So equally weighted has also been known to outperform over time. And then with the dividends and equally technical math signals that tell us when to sell and when to buy, in order to avoid those big losses, those portfolios can do really, really well over the long run.
And I would think dividend with mid caps, you said, would have a lot more upside potential.
Well, mid caps generally outperform large cap stocks. And in fact, I think I told you a story about, when my kids were younger in the 1990s and early 2000s, I invested almost all my money in mid cap stocks because I knew that even though they're more volatile and they go up and down in price, a little return was if I got a good run, a good touchdown or first down or whatever. So I've been doing risk and return since I was a little kid.
Wow, that's pretty cool. I've only experienced that euphoria of being like the rock star on the athletic field like twice in my life, and one of them I made up. So
nice.
Yeah. So that's cool. You've got quite a background as an athlete, as a professional, and now you live in Durango, Colorado.
I live in Durango. It's beautiful. I wish I had. Next time we do this, maybe I'll do it outside with the mountains for the backdrop.
That would make me sick.
Yeah. Oh, sorry. Maybe we shouldn't do that.
No, you were generous and kind. One of the first times we spoke, and I told you about the condo that my wife and I used to be able to use with our friend Joe. It was his condo. He let us use it. And you offered to let us stay at your place, which I might just take you up on that one.
Well, come anytime. We've got a spot for you.
Durango is
it's beautiful.
One of my favorite places.
Yeah. So do you ski?
Yeah, I do. That was one of my.
Started snowing. I'm looking at a mountain right out the window here, and there's snow on the mountaintop. So I think skiing will be starting up pretty soon.
That's wrong. That's just wrong. Well, you had a couple stories you wanted to tell. I think the stories about the pump and dump shop, those stories are cool to me. I was curious if you had one story that they made up about a company. Like, do you remember any of those?
I don't remember the exact companies, but I do remember when I was working for the Wall Street firm. We had something that was exactly like the pump and dump that I didn't recognize at the time as being that, but it was called the stock special of the day. And it would be, maybe once a month or once every couple of weeks, sitting around the office. We had these speakers all over the place, and they were tied right into our office on Wall Street. So they would call you come over the loudspeaker and say, hey, we're going to talk about XYZ company in a few minutes. And then the analyst would come on and tell this great story about this awesome company. They wanted us to sell it to our retail customers. And to top it all off, not only was it an awesome company with a great future for the stock price, but they gave us extra commission. So, of course, as a young guy right out of college, I'm like, yeah, that's awesome. I could use a little extra money to help pay the rent. So for a couple of years, whenever these came up and I really liked the story and thought it was something I could talk to my customers about, I would. And then I started noticing that none of them ever went up in price. At least it seemed that way, or maybe it was just the stocks that I did. But, I was like, why don't any of these go up in price? That's kind of weird. I did a little research and found out that the corporate finance department couldn't sell those to the institutions. So they said, well, we need to sell this block of stock that we have. Let's talk to the retail stockbrokers and have them sell it to the retail public. That wasn't called the pump and dump, but, in my opinion, that's kind of what it was.
Yeah. There's so many things like that take place on Wall Street. And honestly, when I went to work on Wall Street, I guess I was a little naive. I knew that there were a lot of things that were expensive and, people were selling things that weren't necessarily the best for the client. But when I found out about the institutional conflicts of interest, it was kind of an eye-opener.
Yeah, well, I agree with you. I was very naive. I was right out of college, and I had to, I guess, kind of pretend I knew what I was talking about. So I just listened to the company mantra. And it turns out that wasn't always the best interest of the customer.
Again, I'm so thankful to be independent. I think that the role we get to play, and you told me a little bit about pay to play. That's another kind of term, pump and dump, pay to play. Tell us a little bit about pay to play.
Well, pay to play is another conflict of interest in our profession, where if you're an advisor and you have certain relationships where you can do business, or where your customers hold their money, and who you're licensed with, a lot of times those firms make the money management firms like mine, they make us pay money to be on those platforms, to have the ability for the advisors that use those platforms to have the ability to offer our funds and our money management services. And so you can't always find our stuff on all the biggest platforms, the biggest brokerage firms, because we can't necessarily afford how much we have to pay them to get on the platform. Mm-hmm. So we really want to work with someone who's completely independent, who doesn't have any of those alliances that limit what their customers are allowed to invest in. Because you want a person that you're paying a fee to manage your money. You want them to be able to do the best job for you, and that might not be able to be to happen if they don't have all the options that are available out there.
I learned that, I told you I was the first CFP, the only CFP in the Houston area who was a State Farm agent, and the only State Farm agent who could charge a fee for financial planning. And that was one of the big limitations for me, to be a financial advisor who was a certified financial planner, but I had a very small handful of mutual funds, no individual stocks, no ETFs, none of the really good stuff that I use today. And I could, so I was very limited because of, like you said, that was the company that I worked for. And then from there to Morgan Stanley, I thought it would be wide open, but it's not. And plus the incentives are always great. They hold the carrots out there to sell certain things that, like you said, may not always be the best for the client, but they're the proprietary stuff that the firm puts together, and that's where the profit margins are, and that's what you get paid the most to sell.
Right. So again, I guess, to repeat, the best thing that any investor can do is make sure that their advisor is an independent advisor and has access to all the investments that are out there.
Yep. So do you have any other stories you want to tell us about risk or football or?
Well, I guess I've got a lot of stories. I don't want to bore you anymore with any today, but I'd love to be on the show again, and maybe we could tell a few different stories.
That'd be great. And the other thing, I don't know if you're able to do this, but it would be really cool, I think, if you could. You call it a technical overlay, I believe, a tactical. Yeah. Tell me what that is. And then my ask is if we could get back together and you could kind of show me how that works, and maybe we could share a screen. But
yeah, so we're, as we mentioned earlier, our strategies are based on 100% math. And so we have what's called a technical buy-sell signal. And it's basically a moving average crossover signal, which a lot of chartists and a lot of technicians use. Some guys and ladies that do day trading use them on these charts that are really short term, like they'll look at a minute-long chart that changes every minute, or a tick chart that changes every time there's a buy or a sell on a stock. We don't do that. We look at longer term trends because what we're trying to do is just avoid those big bear market losses. So we'll look at this chart, and when we get what's called a moving average crossover on the moving averages that we use, then that's our bear or bull signal. So when it crosses to the downside, it's a bearish signal, which means we're going to go to the sidelines and be defensive. And when it's a bullish signal, we're going to be buying back into the market, back into our particular index or our products that we've developed with S&P Dow Jones custom indices. So basically, it's just using math to avoid the emotions of buying at the wrong time. Because that's one thing that we talked about earlier when we first met, is the buy sell stuff, and retail customers buying at the wrong time. Most of the time they'll invest more as the market's topping out, and they'll sell when the market's bottoming out. And I gave that example of my mom, who since 1982 has called me 3 times to see if I can get her out of the market, even though she wasn't in it. But she was the typical retail investor panicking at the bottom. 1987, 2002, and March 6th of 2009, Mom called and said, "Hey, Jim, if I'm in the market, get me out." Now, March 6th was a Friday. March 9th on Monday is when that bear market bottomed out, and it had come down about somewhere, depending what you're invested in, between 50 and 60%. And most people base their decisions on their emotions. It's part of this behavioral finance thing that there's actually, you can go to college for now. But the emotions are the worst way to base investment decisions, or in most decisions really. But in the investment world, what that translates to is a lot of people will sell at the bottom because of the fear and they don't want to lose any more money. And that's about when it's the bottom. So when my mom called March 6th of 2009, I figured that it was close. The bottom was close. I actually told a bunch of my friends, "Hey, bottom is in." My mom called me.
The mom signal.
Yeah, the mom signal. That's not what we use, but she's really the only one that has hit the nail on the head every time.
That's great. Well, as we close out today, Jim, I want to thank you very much for spending some time with us here at Family Wealth Builder Academy. This is kind of new for me, and I'm looking forward to some more time together with you in the future.
Awesome. Well, I appreciate the chance to speak with you and to see you, and hopefully we'll do it again soon.
We will. And as I close this out, I'm going to play a video I've been working on. So you'll want to get on your little Surface Pro, and be on Facebook when I hit the button and we go live here. And I'll shoot you a text message just before that happens.
Okay. Sounds great. Thanks a lot. See you later, everybody.
All right. Bye.
Bye. Okay.